Did you know that there are two property markets in the UK? There's the one everyone sees on Rightmove, and there's the hidden market where professional investors find their deals, the dark web of property investing. Okay, it's not quite like that, but over the years I have learned that while everyone battles it out over the same listings, you can find some amazing deals by doing the exact opposite. So in this video, I'm going to share 7 insider tactics to help you access this hidden property market, spot opportunities before they go public, and secure deals that other buyers don't even know exist. So to start off, let me ask you a question. What happens when you drop a stone in water? The stone drops, hits the water hard, makes a big splash in the center, and then you see that splash slowly ripple out and fade away. Now, let me translate this to property. If I gave you £250,000 to invest right now, where would you put it? A lot of people would say Manchester, with a £230,000 average price and solid 3.4% growth. Now, I'm not saying that Manchester is a bad investment, but Manchester is where the Northwest boom started. It's the metaphorical centre of the splash. But what if I told you that less than 30 minutes away, you could buy a property for £176,000 in Wigan? That's £53,000 less, and it's growing at 5.2%. That's nearly 50% faster than Manchester itself. And look at some other areas around Manchester city centre from the latest home track data. There's Blackburn with a £142,000 average price showing 4.9% growth. Bolton with a £175,000 average price and 3.5% growth, and Rochdale also at £175,000 and 3.6% growth. So here you can see how the boom in the centre of Manchester is slowly rippling out to surrounding areas, which is why we call this the ripple effect. So if you want to spot this yourself, the key is to look not just geographically, but specifically along transport routes, especially train lines, because these connections carry growth outwards from the main city centre. But to make this strategy work even better for you, you can look for areas that not only benefit from this ripple effect, but also have significant development taking place themselves. Take Preston, for example. Not traditionally trendy, but there are major development projects happening there right now, as well as it benefiting from the Northwest ripple, which is why it's somewhere that we've targeted for some great deals for our clients recently. While nothing in property is guaranteed, finding these ripple areas gives you 2 advantages: lower entry prices and potentially stronger growth. Now, you don't have to use this strategy. You can still find great deals anywhere by applying the other tips I'm about to share, but finding an area on the up definitely gives you an advantage. And once you've found the right area, the next challenge is to spot properties with the most potential. And this is where most investors go wrong. Back in the day, I discovered a very weird hack on eBay. Don't judge me, but I saw that luxury products with misspelled titles, like GUCI instead of GUCCI, or Dolce & Gabbana, would sell for a fraction of their actual value. These items were impossible to find in normal searches, which meant no visibility and no competition. So what I would do was buy them cheap, then simply list them again with the correct spelling and make a profit. Or at least that's what I told my mum when she asked why I had boxes of designer high heels under my bed. Anyway, over time, the search engines got smarter and my tricks stopped working. But it taught me something important about property that I still use to this day. The best opportunities are often hidden by simple mistakes. So I go out of my way to look for properties that are poorly marketed, like there are only external photos, or there's a 3-bed listed as a 2-bed, or it's got the wrong location on the map, or there are only awkward viewing times. Most buyers scroll past these problems and assume that the quality of the property is bad. But these are exactly the kind of properties where competition drops dramatically, and that's where you'll find the best deals. Remember, bad listing doesn't equal bad property, and bad estate agents can be an investor's best friend. However, while bad estate agents are great, there's another type of agent who knows about properties months before they hit the market: letting agents. They work directly with landlords every day and know who's considering selling long before an estate agent ever gets involved. But if you just ask a letting agent for deals, they won't be too interested. There's a knack to make this work that I've personally used multiple times to find great off-market deals, and that is to promise to keep them as the managing agent after you buy the property. Because when a landlord sells, the letting agent usually loses the management contract completely. So if you keep them on as the managing agent, you've turned their potential loss into a win, which creates a powerful incentive for them to bring deals to you first before they ever hit Rightmove. At any given time, there are two types of sellers. There are those who are actively selling, the ones you see on property portals, and there are those who are planning to sell but haven't taken that step just yet. Which group do you think has more potential for great deals? In my experience, it's the second one, and there's a surprisingly simple way to reach them that most investors never consider: put letters through doors. It might seem old-fashioned, but a well-written letter can literally open doors for deals that aren't even close to being listed yet. I've got to warn you, this is a numbers game, and the vast majority of time you won't get a response. It only works if you've got a tight geographical target area, you've got the time to put in, and you know there's enough upside in the deal to make it worthwhile. But remember, you only need one yes to find a deal that no one else knows about, and it will make the work well worth your time. Now, this next strategy won't work for everyone, but if you have expertise in a specific area of property, then this is for you. Let's imagine you are a builder. You go to an auction and you see a property that's tilting alarmingly to one side. 99% of people in the room will be scared stiff. You might instantly know the renovation costs, how long it will take, how to save money, where to buy materials, and who you need to help. I've done this myself on a deal where I partnered with a builder because he'd spotted a listing with superficially scary subsidence that he knew could be sorted relatively cheaply. So we were the only bidders. Or consider flats with cladding issues. While most buyers run away, those who understand the remediation costs can buy with cash at a discount, wait for the issue to be fixed, and profit when the property becomes mortgageable again. Then there are properties with short leases where there are less than 80 years remaining. If you understand leasehold law and extension costs, you can make informed offers while others hesitate. I don't do this myself, but I've seen specialists use their knowledge to find incredible deals that others couldn't spot. In other words, lean into your expertise and use it to your advantage to buy deals that others would find intimidating. So now you can find the right area and spot hidden gems. But what separates successful investors from everyone else is their ability to actually secure these properties at the right price. And after managing millions in property investments, I've narrowed it down to 3 powerful strategies that have the biggest impact. And the first one is specifically for anyone interested in new builds. Most people don't realize this, but timing is everything when it comes to buying from developers. For example, we do a lot of our deals at the very beginning of a project, when we can de-risk it by agreeing to buy a number of units in bulk and allow the developer to get better terms on their financing as a result. But something that's more achievable for most people is to get involved not at the very start, but at the very end. When a developer is coming to the end of their project, they often just have a few units left to sell. So let's put ourselves in their shoes for a moment. They've got a sales office on site, they're paying staff to be there, and they want to move their team onto the next project. But they can't do any of that until they sell those final few units. At this point, getting the last few properties sold becomes more valuable to them than getting the best price. The longer they wait, the more they lose. So if you can identify these developments in their final stages, you're much more likely to negotiate a deal that works in your favour. So keep an eye on local developments that seem to be close to an end, make friends with the people in the sales office, and when the timing is right, you'll suddenly find there's a lot more flexibility. Even if there's a limit to what they can do on price, you'll often find you can get extras like flooring, blinds, and appliances thrown in to get a deal done. And that's the funny thing about property deals. Most buyers do things completely backwards. They look at the asking price and put an offer that's ever so slightly lower. For example, if the property's asking price is £200,000, they'll offer £190,000. The problem is they want to have their offer accepted, but they should want to have their offer rejected, because once you've made an offer, it's almost impossible to negotiate down. If your first offer is accepted, you've gone in too high. And remember, the property might be way overpriced in the first place. Instead, start by forgetting the asking price and figuring out the actual market value of the property. Then go in well below that. So maybe the asking price is £200,000, but I believe it's truly worth £180,000. In this instance, I might start at £150,000, expecting it to be rejected, because then I could always come up a bit and try again. And here is a bonus hack for you that almost nobody does. Imagine your maximum offer in this deal was the £170,000 that would represent a small discount to its true value. You bid up to your maximum and it gets rejected. Now, almost all investors will mentally move on at this point, but that is a massive mistake, because offer accepted doesn't mean deal done. In In fact, about 30% of property deals fall through after the offer is accepted. Something happens that kills the deal. Now, logically, you'd think that estate agents would go back to everyone who'd showed an interest, but much of the time they don't. They just stick it back on Rightmove and the process starts again. But if something has gone wrong after the seller has already found their next home, and they'll lose it if the deal falls through, they are going to go into panic mode. So if you keep on following up relentlessly with the agent until contracts have been exchanged and you know for sure that the deal is done, you will be top of mind if something goes wrong. And if you're able to move quickly, you can come to the rescue, solve the seller's problem, and secure yourself the deal of a lifetime. However, how do you actually know a good deal when you see one? As I mentioned before, unless you have a specific area of property expertise, the most amazing deals often turn into complete disasters. So check out this video next, where I explain how professional investors analyze properties to make sure all the numbers are safe as houses. Literally.